Okay, so welcome everybody again formally. And so we are now going to be looking at the forecast system that we're helping develop, and be interesting to see Mark has taken on some ideas from last meeting, whether or not they've actually been able to be implemented. But Mark and Steve are working with us closely and listening to suggestions. And again, any suggestions, any feedback you give will be taken on by us and look to develop this software. You're going to be able to get a free copy of this, so afterwards you'll be sent links. We'll download the recording, we'll download the module, and you'll be sent links to allow you to be able to download tomorrow, hopefully. But if I'm not going to kid you, it's quite complicated, and so we can't turn people who are not accountants into accountants. But what we don't want to do is just say, look, this is all about give it to us, give it to us. What we're trying to do is make it available to you. It's really important to be able to have. I've had one forecast done for me recently by a client, and I had to go to them. I said, look, it's fine, but it doesn't actually reconcile. It doesn't add up. So your figures might be right, but you've got no controls on it, and so it could be totally wrong because you're not actually reconciling all the different variables, which of course went straight over the head because I'm talking in yuck speak. But this is a system that will control everything. So you will get forecast balance sheet, you get forecast profit and loss, and forecast cash flows automatically with a report to funders if you need it. So that's what's so good about it and why we want to share it and give it away free. It's part of a much bigger system that we're working with at the moment, but the forecasting was far important. So enough of that from me. If I can hand over to Mark Walker, would you like to I'll unshare my screen and you start sharing yours, Mark.
Thanks, Mike. Hi, everyone. Mike, it says you've disabled screen sharing.
Oh, have I?
So I think what you might need to do is if you click participants.
Click participants, yeah.
And then bottom right hand part of that box, you'll have 3 dots.
Yeah.
Is there an option there?
Yes. Participants can chat. No, so share. Let's just share. Share screen. Is that advanced sharing options? Multiple participants can share. One participant can share at a time, it says.
Yeah.
Let's say multiple participants can share. See if that helps you.
There we go.
Yep.
Right. So can you all see my screen? Is that working now? Yep, brilliant. Got a thumbs up. Fantastic. So as Mike said, this model has been prepared and produced to enable applications for funding under any scenario. The scenario which I'm going to use today is a business which has been severely hit by the COVID-19 pandemic and has had to close for a period of time. Just going back to a point that Mike touched on earlier, is kind of the lack of detail which is being presented to funders when not for the bounce back loan, because that seems a really straightforward process, but for anything over the 50 grand mark, is they're going to need a certain level of detail. Like it or not, you're going to have to provide a certain level of detail, and the reason they need that is because they need to understand how the business was performing before the pandemic hit, how the business is going to perform as a result of the pandemic, and what funding is required to facilitate that business going through the short-term pain and show that they can get out the other side. And they need all of those 3 sets of information. So what we've designed is a model that's got a methodical approach that at the end spits out everything you need just in one document. And there are various assumptions which you need to be aware of throughout the model. We've limited it to only those that are essential, but there are still quite a few of them, because if you think about it, you not only have to think about the impact on your trading performance, you have to think about what we call non-trading impacts, i.e. are my customers going to be able to pay me? How am I going to pay my payables? What do I need with regards to any capital investment over the next few years? So there are all sorts of assumptions which we need to build into that, which all impact the most important figure within your business, which is your cash position. So what I'm going to do is we're going to go through the model, the universal model, as we call it. And universal means that you can just input any data you want from any accounting system. If you're on Xero, as Mike alluded to, they might be able to help you out with the production of the first part of it, which is getting the data actually into the model. Because after that, everything is exactly the same. So we're going to go on the assumption that we have data that we need to put into the model, and that you're on a package other than Xero for the moment. So the model will come a series of tabs on there. They're all color coded. So the first set of 3 tabs are grey, and they just talk about process and presentation. So the first tab will give you all the information you need, and we'll talk about how the other tabs work and what needs to go into the other tabs. I'm not going to go through that in detail because I'll talk you through that as we go through the model. But also everywhere in the model are what we call tooltips. So you'll see a red triangle. All you have to do is hover over that red triangle, and that will tell you what you're supposed to do. So you're never too far away from any help. And also, Mike's team are on the other end of the phone if you get stuck as well. So first thing is preparation of data. So let's say I'm using Sage. So I know someone on the call uses Sage. So let's say I'm using Sage. What I need to do is I need to prepare my data. Now you have a tab called Sample P&L and Sample Balance Sheet, and that just shows you how you need to lay out your data. And they're the only 2 bits of information we need. We need a P&L with some history to be able to, again, going back to my three things you need to talk about and show how the business was viable before the pandemic hit. Because if you've made a loss forever and a day and have just funded that by chucking your own cash in, you are far less likely to be able to receive funding from a traditional funder than you are if you can show a stable profitability performance. So you can put in up to 5 years worth of data. The more history you show, the more reliable and the happier the funder will be this reviewing the documentation. So the sample sheets show you how to prepare that. Now in the first column for P&L, you just need the P&L line. So we call them sales nominals, but essentially it's a line on a P&L. So and generally when you download a P&L, you're giving your sales lines first, and then your cost of sales lines, and then your overheads. So first column needs to contain that description, and then starting from the most recent accounting date, i.e. the month the accounts are most up to date to, and then heading backwards over time from left to right. And again, put as much information in as you can, and you can put up to 5 years worth of information in. We'd probably say you want to show at least 2 years, because you'll want to give the funder some comfort and some understanding in the performance of the business. So at least 2. If you can put 5 in, great. Balance sheet is a lot simpler in that you've got one column which are your balance sheet lines, or balance sheet nominals as we call them. And again, they'll generally come in this format where if you download a balance sheet, you'll get your fixed assets, and then you'll get your current assets, and then your current liabilities and long-term liabilities, finally capitals and reserves. So that's generally the format that the balance sheet comes in. So once I've got my balance sheet set up and I've got my P&L set up in that format, I then just need to paste it into the relevant tabs. So with regards to my P&L, the yellow column, and if I'm unsure what I need to put in the yellow column, again, there's a red triangle there that I can just hover over, and it will tell me what I need to do. So this column should contain the P&L nominal descriptions. Each month should then be listed the next column onwards, starting from the most recent month. So there are my descriptions. There are my values, starting with the most recent month, heading backwards in time. And then all I need to do is tell it what month this column relates to. So if this is March, it's fine, it's there. If I've got them up to April, I just change that to April. And all this is for is so we understand and we can label all of the other months. So you haven't got to label all of the months as well. You just get the information in there. Again, if you're a zero client, then Mike can help you, and you won't need to do this part of it. I need to put a company name in, so I can't leave Demo Company Limited in there because I can't give a report to a funder that's got Demo Company Limited on it. So you just put your name in there. And then what I need to do is I need to categorize the lines on my P&L. And all that means is I need to tell it whether it's a sales line, whether it's a cost of sales line, or whether it's an overhead. And again, your P&L will generally come out in the same format, which is sales, cost of sales, overheads. So it will be really, really simple and straightforward for you to classify, because you'll just put a load of sales lines in, then you'll put a load of cost of sales lines in, and then you'll put a load of overheads lines in. What I've done here is I've just labeled some of these for you to give you an understanding of what they might look like. So there's my P&L information. I've put in 5 years worth of data, so I can just scroll across. I've got 5 years worth of data in the model, and then I do my balance sheet. I do my balance sheet in exactly the same way. So the yellow column just has the description of the line, and the orange column has the value or the balance on that line. And then all I need to do is give it a classification, and again that will be pretty much exactly the same layout as you're seeing on the screen in front of you. I need to tell it whether it's a fixed asset, a current liability, a long-term liability, or shareholders' equity. And if you're unsure, just use the subcategory that it rolls up into. What I need to make sure when I'm categorizing is that I exclude, and again it'll be shown in the tooltip, I exclude any headings, any subheadings, any subtotals or totals. So I just want to include the actual lines, nominals as we call them, the actual lines themselves. I don't want to include any headings or subtotals or totals. So that bit is all you need to do to set the model up, and get the data into the model. And now it's about how I prepare my forecast. So if you think about those three sections, so the history, what's going to happen, and therefore the funding requirements, I've done my history bit. So that history is there, and when I press the button to produce the report, that history is in there, and it will be graphically as well as represented in words within the report. Now what I need to do is actually the difficult bit is understanding exactly what's going to happen in this business going forward. So you start off with the baseline forecast, and this is the profit and loss account, which is reflected based on the P&L that you've input onto the monthly P&L tab. So I've got, if I start from the left hand side, again the structure of the P&L is just laid out here, and then I've got my last 2 years worth of information, 2 years worth of performance by month. So I'm showing that by month, and what we use that for is to enable us to understand the trends of the business. So we understand that, for instance, for these particular lines, what we did over this year, which is the last 12 months compared to the previous 12 months, and then what was that year on year, what was that movement. Now we've been really imaginative with the numbers in this example because it's just all 5%. You will have different, these might be, I'm thinking, and I'm probably going to use the wrong examples, but if you think about these sales nominals, as we've called them, these are various sales channels. So within dentistry, as an example, I don't know, you might have checkups as one, you might have special treatments as another, you might have other stuff, but you'll have various lines within your P&L. Then you're showing the performance of those sales channels over the last 4 quarters. And again, you'll see there, we've got 5% really stable business, 5% increase in each of those quarters. And the reason that's important is because the model will automatically provide you with a starter for 10 forecast. Now that will be based on your performance over the last 6 months. It will adjust for seasonality. So if a particular sales line, you only sell that in, let's say, 3 or 4 months of the year, it will reflect that in the forecast going forward as well. So it will start off, it will say, how have you performed year on year over the last 6 months? Let's take into account the seasonality of this line, and let's just project that forward. That doesn't mean you have to stick with that. You can do whatever you want. But that's what so this top line, the reason I've left that in there is that's how it will be presented to you. I've already adjusted for speed. I've already adjusted these other lines to be a revised forecast. So that's saying I'm going to apply 5% increase going forward. If I want to change that to 15, I just type 15 in and it will change that number. And then it will turn orange, and it turns orange to say, okay, well, you've made a different assumption than the last 6 months that we started with. And that's all that orange means. If I want to set it to 0, I can. If I want to set it to, actually, we're going to be 25% down, I can do, and it will maintain that phasing. So I can take that approach, or I can key in a number, do whatever I want. I can put a calculation in there if I want to. If I want to be really, really technical, I can put a calculation in there. But what I'm going to assume for this business going forward is I'm going to assume that over the next 4 months, I'm closed. So I've got no revenue in this business. So a scenario, at least 2 of you on this call are looking in square in the face. So I'm going to be closed for the next 4 months, or minimal revenue. And then it's going to be a very, very slow build back up to what would be normality. So all I'm doing here is I'm assuming that we will achieve 25% of the previous year, 50% of the previous year, 75%, finally getting to a point where at some point next year, we get to a point where we're operating on an even keel to where we were. And this is really important because we need to understand what that sales profile is going to look like. What you need to note as well is that you can forecast by month for the next 24 months and then annually thereafter. So we've done the first 12 months there. We then go into the next 12 months. And again, it starts off assuming that you will achieve what you achieved in the previous year, which is why I've just changed this line. And that's now given me, it's assuming 0 there. So all I'm going to do is put in a figure that I think I'm going to achieve. So I've gone from a position of the next 12 months, my sales are going to be hit considerably. And if I go down to the total column, I can see that I was achieving 930,000 in the most recent 12 months. I think over the next 12 months, that's going to drop to 273. And then I'm slowly going to build back up to achieve 814,000 the year after. And then I've just put in some standard assumptions in years 3, 4, and 5. You can either type a percentage number in for that increase. So if I want to be 10% up, it can be 10% up. Or you can type in an actual figure. And I can type that number in there. So the idea of this is you can do whatever you want in the model. You can't type where you're not supposed to type. So you're not going to impact anything. You're not going to throw any balances out, as to Mike's point earlier. It's all going to match up and reconcile because you can only input where you're supposed to input. And the idea is that you come up with quite a detailed forecast at the appropriate line level over the next 5 years. And for a lot of businesses, this is the reality that this year is going to be really, really poor with regards to trading performance. Next year, you're probably only going to recover what you've lost, and then years 3, 4, and 5 are probably where you're going to start to see some growth. So that's looking at sales. And if I need to add in any new customers or any new sales channels or any new activity which is already planned to happen, again, I can do that. I can do that with using one of these new customer lines. So I've got my assumptions around sales. So I'm going to be hit considerably by sales on my sales forecast. Now I look at my gross margin percentage. Now at the moment, again, we're looking at ways in which we can refine this further going forward. At the moment, we drive our cash margin, or our gross profit, whatever you want to call it. We drive that via the margin percentage. And all we've done here is you're given the margin that you achieved in the most recent 12 months, i.e. here we've achieved 71%. You can just reflect that 71% going forward as you type that in the annual column, and that will just reflect that each month for the next 12 months. Or you can type an individual margin rate into an individual margin month if you've got a business where margins fluctuate. I'll just undo that. So I've assumed here we're going to maintain that margin rate of 71% for the next 12 months. And then that's just going to increase by 0.5% the year after, and a further 0.5 every year after that. And then we come on and we look at overheads in exactly the same way. So you're presented with the information in the same way. If I want to go back and look at my history, I can either view that as an annual figure for this year and last year, or I can go back and look at the monthly figures. And in this case, I've just made a few assumptions around what's going to happen to my overhead line. So I'll just go through what they are. Now, my salaries, I've assumed that for the next 4 months, well, furlough's going to apply, but I'm topping up some of those salaries myself. So I've just assumed £1,000 a month, and then slowly building those salaries back up as my sales increase to what would be a more normal level. I've got rent. I've got a really kind landlord who's allowed me to defer 3 months on rent, so I've wiped that out for the next 3 months. I'm still going to spend on advertising and marketing, but not so much. So I've just reduced that for a little. And there are other lines where I've tried to mitigate as much as possible my cost base to manage to as much as possible reduce the impact on profit. So again, all I'm doing there is I'm inputting some numbers, or I'm inputting a percentage movement, and that is essentially, you can do whatever you want to generate those. But the idea of this is to reflect what's going to happen by month over the next 2 years for those cost lines, and then annually thereafter. You'll see a few other things to note. You'll see that there are some lines which have minus 100%. That doesn't mean there will be no cost incurred, but what it does mean is that the assumptions for those are taken care of elsewhere in the model. And what you'll see, if you hover over the tooltip above that column, you'll see in the notes section, so any nominals that have description including interest paid, tax or depreciation are set to 0 as they're calculated on the 3-year forecast tab. So my assumptions for those are dealt with elsewhere, so that's why you'll see a minus 100%. And then finally, unfortunately, again, many businesses are going to be faced with this scenario, in that I'm going to have some bad debts probably if I'm a B2B business. You know, a lot of businesses are going to be in the same situation that I am. So I've probably got outstanding receivables that I'm unlikely to recover. In order for those bad debts to be calculated correctly and flow through to the appropriate elements of the balance sheet, you need to input them in this line. So all I've done here, I mean, this is my history. All I've done here is I've assumed that we're going to have £25,000 worth of bad debts, and that's going to hit 10 in May, 10 in June, and 5 in July. So I've just assumed that for this business, you know, £25,000 of their outstanding receivables aren't going to be recovered. So that gets me down to a position where, if I look at my net profit, I've got 240,000, which I achieved in the most recent 12 months. That's now going to reduce. I'm going to make a loss in almost every month to a loss of 111. We're going to recoup that in the following year, where we're going to get up to 208,000, and then we're going to start to increase our profitability thereafter. But we're effectively going to be in limbo for 2 years, in that our profit in year 2 is probably going to offset our loss in year 1 for most businesses. So that's setting my my trading expectations for the next 5 years. Now, obviously, your trading doesn't necessarily reflect your cash position like for like, so we now need to input our assumptions for those non-trading elements. First thing we do is we have to classify our balance sheet. So we've already pasted in our balance sheet, and we've already told the model whether the line is an asset, a liability, or a long-term liability. All we now need to do is understand the treatment that I'm going to apply to that, because this is where the various assumptions that you're going to make on your 3-way forecast tab, this determines which figures roll up into those assumptions. And again, it should be really, really straightforward. You've got a drop down that you just select how you want to treat that particular line. Most of your lines on your balance sheet will be called really simple, will have really simple descriptions, and you'll be able to apply an assumption to those really quickly. So stock, well, it goes as stock of work in progress. Accounts receivable is a receivable. Anything which has cash instantly available, i.e. a bank account or a PayPal account, should be treated as cash. Something like a rental deposit we don't really want to impact that balance throughout our forecast. So if we select other there, that's just going to maintain the same treatment and going to maintain the same value. So I do that for my current assets, my current liabilities, and my long-term liabilities, and I select the appropriate treatment to apply. So probably something which will only take a minute, but really, really, really important that you get that bit right, because that's what will feed ultimately your cash line on your three-way forecast. So I've set my trading expectation on my baseline forecast. I've set my treatment for my balance sheet lines. Now I go in and I input my non-trading assumptions. And again, for ease, what I've done is I've pre-populated this, and I'll just talk through what I've done rather than key it in as we're going along. Essentially, wherever there's a blue cell, you're required to make an assumption. Now that assumption might be nothing, and therefore you might leave it blank, but you're required to make an assumption. And the first thing you're given is a depreciation percentage assumption. Your starter for 10 will be whatever that has been in the last 12 months. So based on the entries in your P&L for this business as an example, the depreciation that's being applied is an average. And again, you might have different assets with different depreciation treatment, but the average across them is 32.4. So that's what it's applied. I'm going to leave it at that. If I wanted to change it to 25, I just type a new number in, and that will flow through. Anywhere there's a blue cell, you can input. Anywhere where there's not, you can't. You'll get a message, and that ensures that everything still balances. I've got some on my balance sheet. I've got a bank loan of 5,000, so I've got some debt which I've classified. I now need to look at the treatment of that debt. Now, again, the model will look at the interest charge in your P&L, and it will look at your opening and closing debt balance, and it will say roughly this has been your interest charge for the last year. If that's right, great, leave it. However, there will be lots of, there could be various bookkeeping entries which might alter that number. And if actually that number is more like 7.9%, we just type 7.9 in. What I've assumed for this loan is actually I've only got 2 months left on it. So I've got 2 months where I'm paying interest, and then I've set it to 0 after that, because there'll be no interest on that loan going forward. I then come down to my inventory or stock days, however you want to refer to it. Now, this should be treated in conjunction with the stock line, because ultimately what you're doing here is you're saying at that point in time, how many days stock am I holding based on my last 12 months? So that's what that's doing. But all you need to do is key the number in. So for this business, over the last 12 months, it's held an average of 156 days stock. And we just need to, so what that's driven, if I go down to the balance sheet, that's driven, so I've currently got a stock holding of £116,000, which if I go back to my balance sheet, which is this number here, I now need to assume what's going to happen to that going forward. Now, I've just put some rough numbers in, but effectively, one thing you need to think about is if you're in a business that's got a lot of stock and you're closed for the next 4 months, well, there's nothing you can do. Can't get rid of that stock because you're not making any sales. So your stock days are going to increase. You might want them to decrease, but they are going to increase over the next 4 months because you've got no stock at all. So all you need to do is reflect the phasing of stock in that line there, and that will drive the stock balance on your balance sheet. Accounts receivables and accounts payables, you'll notice they're not blue because we'll come on to those in a second, because the assumption for those are slightly different. I'm not going to go into detail for these two lines, other than I need to assume the corporation tax liability, when it's going to hit the accounts and when I'm going to pay for it. So as an example, my corporation tax of £15,000, which is on my balance sheet, which is outstanding, which is this number here. I've assumed our year end is March, and therefore that 15,000 isn't going to be paid until December. And then you do the same in the next year, and the next year, and the next year. Obviously, any help understanding what that corporation tax charge might be, you might need to discuss that with one of Mike's team. Then the important bit for everyone, what dividends am I going to take? Because generally the owners, if the owner of the business doesn't take all of their remuneration through salary, they take some of it through dividends. I need to reflect these here. And for this instance, I've assumed £1,500 a month this year as a minimum for what's required, going up in subsequent years to 2,000 a month, and then 3, 4, 5. Again, coinciding with the downturn and then the increase in the profit. Obviously, you need to make sure that the reserves are there to be able to pay yourself, and it's all being done correctly. Next, we come on to capital expenditure. So what assumptions have I got around capital expenditure? And I've assumed that in this business, generally we're investing £4,000 a month in capex. However, I've stopped that for the next 4 months because I'm not trading. And then after that, I've input 4,000. And what that will do is the balance, therefore, on fixed assets will then have this this depreciation charge applied to it. So if you want to change that, again, you can change it to any number you want, and that will change the charge which is being applied. I then come on to the capital element of my debt, because I've dealt with the interest in my assumptions up here. I now need to look at the capital element, and all I've done here, much like the interest, I've assumed that I've only got 2 months worth of repayments left. I've got 5,000 outstanding on my loan, so 2,500 in April and 2,500 in May. So I've assumed that repayment, and then that debt is going to be all gone. So we can see here that by the end of, if we go down to our balance sheet, we go to the debt line, we can see that by the end of May, our debt has now been reduced to 0. Now that's the existing debt within the business. That's not any new debt. That's dealt with elsewhere. And then finally, I've not made any assumptions on that in this particular example, but any equity. So if you're looking to issue any equity or any share buybacks, that would be dealt with on this line. And again, that would have the relevant impact on your cash and your shareholders' equity line. So they're the initial non-trading assumptions that I make. Then I need to come on to probably the 3 key assumptions within the model, which are VAT, which are accounts receivable, and which are accounts payable. And there's a lot which will probably happen on these lines, and they'll be business and sector specific as well. So again, where there's a blue line, I should make an assumption, and where there's not, I can't do anything. So you're not going to break anything. You just need to make the relevant assumption. So the first thing we're going to focus on is VAT, and we're going to look at our two elements of VAT, which is output VAT and input VAT. Mike made a really good suggestion last week, which we're looking to build in, but you will still see your average VAT rates displayed this way going forward. So the first thing is, what's my average output VAT rate? If you're unsure how to calculate that, well, there's a description there which will give you broadly an assumption of how to calculate that based on your VAT return. If all of your sales are VATable, then it's just 20%, because you're putting in your average VAT rate. And then you do the same for input VAT as well. Input VAT, what it does is it takes if you look at your P&L, it takes anything that's classified as a cost of sale or an overhead and includes that in the VAT calculation. If you've got a line on your P&L which is salaries, or you might have even dividends on your P&L historically, any of those lines, they will roll up into salaries and dividends, and therefore won't impact the VAT calculation. So I need to assume my average output and average input VAT rate, and then all it does is based on your sales, based on your purchases, it will work out what your outstanding VAT balance is at a point in time. And then all you do is you tell it what VAT cycle you're on. So if I'm on a January, April, July, October VAT cycle, it will then assume that your outstanding VAT is paid the month after it's due. And that just rolls that through. So here as an example, we've got an outstanding VAT at the start of this forecast of 11,000. Because I've not actually got any revenue in the next 4 months, that's reduced in April down to 9. So I pay that in May, and then I'm actually owed a repayment in August, and the assumption is that that will come in. If I'm not doing anything on VAT for 12 months, I just wipe that out, and the balance will just continue to accrue. So as we can see here, the impact of low revenue and lower but not low cost actually means that our outstanding VAT has reduced throughout the year. So all that will do is it will assume the balance at a point in time, and you can choose to pay or repay that whenever you want. I'll just put that back to the normal. So again, if I change the VAT cycle, then the timing of those payments just moves. So that's VAT. And again, it depends completely on what plan you're on, depends on what agreement you've come to with HMRC. You know, it is business specific. Then what I've assumed, or then what we assume now is accounts receivables, and what proportion of receivables am I going to recover in the month? So as an example here, we've got outstanding receivables of 76,000 in this business. And again, this will be drastically different by business and by business sector. And that's just come straight off of my balance sheet, which has got accounts receivable. So I know I'm owed 76,000. I'm not doing any sales in the month at all. So I'm not adding to that number. So at the end of the month, I'm still owed 76,452. And then I say, okay, well, what proportion of that number do I think I'll recover in the month? So in simple terms, if I'm an instant cash business, i.e. I operate either via cash or card, then that number is always going to be 100, because you're always going to receive it instantly. Now, most, if not all B2Bs don't operate that way. So there will be a proportion of outstanding debt. And what I've assumed here for this B2B is that actually we're going to recover a small proportion of that each month, because a lot of businesses are going to be in the position that I'm in, and I'm not going to be able to, you know, I'm not generating revenue, and they're probably not generating revenue, so they're probably not going to be able to pay me. So all I'm doing there is I've put in a small assumption of the amount I think I'm going to recover, and ultimately what that does is that drives a number here. So that's the number that I think I'm going to recover each month, and therefore what we're doing there is we are assuming an impact on our cash flow of not receiving that balance. And we then do exactly the same for payables. So whereas receivables are the amount that people owe me, payables is the amount that I owe suppliers. What I've assumed here is that, you know, one thing we have to take note of is that a lot of what we incur cost-wise is on direct debit. So we either benefit from the service or we don't. So we either pay it or we don't. So we are less likely to be able to mitigate our payments. So I've assumed that we'll only pay 25% for the first 6 months, and then we're back up to paying 50% ongoing thereafter. So that assumes roughly 30-day terms. So all of those assumptions, and again, if I'm not clear about anything, you've got a tooltip that you can hover over, which will tell you exactly what you're supposed to do. So we've put all of those assumptions through, and really all we want to see is the impact on one line, and that's the impact on this line, which is cash. So in this business, we can see that we're starting off with £34,000 cash, which is the number, which is the total of our bank account plus our PayPal account in this instance. And then we can see how that's going to dwindle away over the coming months down to a negative position for June. And then it gets worse and worse and worse as we go on. So we're getting to a point where we got a low point of about £128,000. So we need to do something. We certainly don't have £128,000 overdraft, so we're going to need some funding in this business. Now, if I want to just use the model to create a forecast, well, that's all I need to do. I've created a forecast. If I want to print out these working sheets, I can do it. Print outs on 6 individual pages, or there's a report right at the end, a forecast report, which if I just show you how it prints out, I won't go into the detail. Or there's a forecast report which will produce a report talking about, you know, how the business has performed in the past and how it is going to perform over the next 5 years, and by detail over the next year. So that's how I would use it to create a forecast. But actually what we need to do is we need to create a funding proposal. So now I need to talk about, if you think about those 3 steps, I've talked about the history, so I've loaded the history into the model. Talked about what's going to happen in this business over the next 5 years, how I'm going to go through a period where I'm going to make a loss, but I'm going to come out of it the other side. And now I need to talk about, okay, well, what do I need in order to facilitate that short-term cash deficit? Now, I'm not going to go into it on this call, but there is the facility within the model to cover any type of funding requirement. So if I want funding for some new machinery, or I want some funding for increasing my sales force, or any of that, then you can accommodate that within the same model. But that's a subject of another webinar as to how we would do that. What I'm going to focus on now is specifically how we would facilitate applying for funding for this cash deficit of 128,000. So what I would do, I'll go on to my funding 3-way forecast tab, and if you think about it, the only assumption that's going to change in all of this now is my debt assumption. So at the moment, it pulls through all of the information that I've already entered and already set. So if we go down to I realise I've put some information in here. Bear with me. So what we're doing now is we're going to go through and we're going to say, right, what funding do I require? And when am I going to pay it back? And what impact is that going to have on the business, and more importantly, on the cash flow of the business? So if you just bear with me. Okay, so we're back to a point now where there's our low point of £128,000. So I know I'm going to need at least 128. Actually, what I also need to account for is a little bit of contingency in there, because if that's how the next 5 years is going to pan out, then you need to be buying some lottery tickets, because if you get that exactly right, then you're a better person than I am. And also, there's going to be some additional interest as a result of that loan, and the loan's going to have some capital repayments as well. So I'm going to need to borrow more than 128. So if I'm going to assume within the model, let's put that at 150. And all I do is I go to the debt line. I can see that what's already been pulled through from my previous forecast of that's my existing debt being repaid. So I'm going to put in £150,000 in June. Okay. And there are a few other things I need to do. At the moment, if you remember, I set my interest rate to 0 from June onwards. So now I need to apply the interest rate for the loan. I'm going to assume it's a Receivables loan, and therefore I'm going to assume that I get 12 months interest free, and I get 12 months without having to make any capital repayments. So my first interest payment is going to be of June of next year. And let's assume that this loan, again, at 3.9%. So all I'm doing here is I'm inputting the interest rate that's applicable for this particular loan going forward. So that's 3.9%. And then all I need to do is input the capital repayments. So if I've got 150, let's assume that that's over, let's assume I'm getting it over 6 years, but actually my repayments are only going to be over 5, because I'm getting 12 months of that free. So essentially, that's going to be £30,000 for those 5 years, which is going to be £2,500 from from June of the following year. So all I'm doing here is minus 2,000, and these are my capital repayments each month. So I put my capital repayment in, and then thereafter I put minus 30,000 in on an annual basis. What you can see, if I go down to my balance sheet now, I've got my cash position, which is showing, I'm currently at 34, which dwindles down. Then I'm up to 145 because I've got that injection of cash in June. And then my cash position gets as low as 21,000. So now I'm in a position where actually, okay, I can demonstrate. So I've demonstrated from a trading perspective that I've gone through a period of time where I've hit some difficulty, but I can see a way out, and I've demonstrated that within my forecast. What I'm now showing is how I'm going to facilitate me getting through that short-term cash deficit. I'll then go down to my debt line, and as you can see, I've got £5,000 currently outstanding, which is going to go by the end of May, which was my existing debt. My 150 comes in. I don't start repaying that until June, and then by the end of the 5 years, in this particular forecast, I've only got £35,000 left with regards to outstanding debt. So a lot's been done there, and I think you'll agree that if you were to just give all of that to someone and go, there you go, it'll probably take them a while to go through it. So what we now need to do is we need to articulate all of this in a nice, easy to read report. And then to generate that, all you do is click Generate Funding Proposal. So you click Generate Funding Proposal. It will ask you where you want to save it. I'm just going to save it to my desktop. And you'll get a notification when it's prepared. So what it's done is it's just taken all of the information which is within this model and produced it in a report. You still have to do a couple of things to the report. So what I'm going to do is I'm going to open that. And that will open up there. If I just look at the print preview for this, what you'll see is you've got a report which covers 6 pages, and it's got all of the numbers on there presented in the appropriate way that we've already gone through. The only bit you need to do is add the context to it, because whilst we've gone through and we can generate all of the numbers and we can provide you with objective commentary based on the numbers, what we can't do is we can't set the context. That's for you to do. But what we've done is we've produced the report. The report, without getting too technical, follows a methodology called Campari, which is what most of the lenders follow. And it essentially says, okay, well, what do I need, as well as the numbers, to have some comfort and confidence in your proposal? And we've just prepared some sections for you to complete. So start off with, I need an exact summary, which needs to talk about how much do I need, why do I need it, and what will it be used for. So I just type that in there. Obviously typing in gobbledygook. And then I need a section on the company profile. So what I'm doing here is I'm setting the scene. I'm saying, okay, I need some money. This is why I need it. And this is how it's going to be used. I now talk about my business. And I just put my business in the context of both historical performance and also the market itself. And I talk about my customer base. And I type some words in. I then talk about the financial performance to date. Now, this is where the history comes in. So the more history I put in to my P&L, the more history I have in my accounts, the better informed the funder is. And what you're presented with is some narrative about performance, which again is objective, just based on the numbers. And you may want to add to that, or you may want to put in whatever you want to put in. You can do whatever you want. I'm going to stick with what's automatically generated. And then you're presented with some graphs which talk about, again, performance. So in this business, we've seen revenue growth over the last 5 years, talk about gross margin and gross margin percentage, net profit trend. So here, what we're demonstrating here is a story of a business that it was not only stable, but was growing and was on a growing trend before the pandemic hit. And then finally, a statement of our net worth at that point in time. So all of that is based on the history that you've loaded from your P&L. And we also talk about the seasonality and the trends of revenue and profit over the last 2 years. So there's enough, and all of that is just generated from those months of data that you enter from the P&L. Then the bit which is probably, you probably know it, but actually thinking about it is the most difficult bit, and that's the SWOT analysis of the business. Really, really important one to give the lender a really good understanding of exactly the state of the business Again, some guidance here if you're not sure on what to put in these boxes, but all I'm doing is concentrating on the internal strengths and weaknesses and the external opportunities and threats. And again, all I do is I type whatever I want to type in those boxes there. So what I've done there is I've set the context, I've set the scene. So now the funder is in a position where I understand everything I need to know about this business. And actually, all of that part is generated purely by the history you enter in the P&L and balance sheet. What I now need to do is talk about my forecast, i.e. what's going to happen and what I need from the funder. So what I've done first of all is how much do I need? So I need my 150. What term have I assumed? Well, I think I assumed 6 years. Then what's that going to be used for? So I think we said 130 was to mitigate short-term cash deficit, and then we had 20,000 I think for contingency, just to break that 150 down. So it's not I want 150, it's why do I need it? And don't be afraid to put contingency in there. Contingency is a good thing. It shows you're actually thinking about it. Then you're given an understanding of the impact that this funding has on your business. Now, in this instance, there is very little impact on the trading performance of the business, because all we're talking about is a cash investment to facilitate to mitigate a cash deficit. There will be a small impact, which will be the interest charge to the P&L, and that's about it from this perspective. Which is why we're given, it'll increase overheads by almost 1%, which is just the interest charge. The more important comment is our cash flow is expected to increase from a position of minus 128,000 to our lowest point, which is actually in 2 months' time, of 5,400. Then a section where I need to input my forecast assumptions, i.e. why is that showing the numbers it is. And then we've got some graphs which show the impact the funding has made on the business. So in this instance, again, because it's had very little impact on the trading performance of the business, the revenue and the profit are similar, whether I look at my baseline or my funding scenario. The key difference is if I look at my funding scenario, i.e. my blue column in my cash balance, I can see that I don't go below zero now. I've got positive cash in the business for the next 5 years, and then the relevant impact on net worth of that business as well. I then show the next 2 years projected forward, because we've projected by month, so we may as well show that information in that detail, showing exactly what my rolling 12-month revenue and profit is going to look like, and then how I see myself getting out of that. Finally, we've got a section for any other information, if we've missed anything out, and then just the numbers which back up that. So what we're not doing in the report is showing a ton of numbers. All we're showing are the key numbers and the key facts that we need to. If we want to refer to anything, it's all in the appendix. So we've got our detailed P&L, we've got a detailed balance sheet, we've got a detailed cash flow, and we've got all of the supporting schedules to back that up as well. And then all you do, so once you've done that, you can save it. You can save it as a PDF, you can print it, you can do whatever you want, but that's there to kind of back up the funding proposal and just provide all of the information that you'll need. So we're not denying it's going to take some thought, but hopefully, the assumptions that you're making within the model are kind of the bare minimum that you have to make for any business. And it's not just about the money in itself. It's about ensuring that you put the required thought into understanding exactly the repayment of that and how that's going to impact the business. So I've probably bent your ears for the last 45 minutes. I'll stop sharing. I'll hand back over to Mike.
Thank you, Mark. Well, I imagine there's loads of questions, so it's really over to you if anybody's got any. I mean, I warned you right at the beginning. It's quite detailed. because it needs to be detailed to give the analysis. And obviously, we'll be there to support you, but it's logical. And what we're going to do is we'll give you the recording of this, so you can actually go through and look at it again, and see if you wanted to try and have I mean, Ali Khan, I know you're a frustrated accountant at heart, so you like to be able to play with these figures, but you know, it all follows a logical through. Once you put your base figures down there, and if you are on zero already, we just download them automatically. All your history will download automatically for you, so that can be done. But anybody else will just have to cut and paste, or just type in the base figures, the history there, and then you don't have to decide on your assumptions. I said, we're looking, as Mark said, we're looking just to develop the model slightly to allow us to look at margins. You know, I'm thinking of Stuart, you know, where you might have your different events with compared to your cocktail parties with different margins. So if once you actually are allowed to do something on events, you know, after your period of lockdown, you might, rather than wanting to average margins, you might want to look to show what if we did this turnover at that particular margin area. We're looking to incorporate that in the model. So lots of things are happening, but it's just giving something pretty comprehensive that's available without you having to become a super whiz on Excel yourself, or have to incur lots of fees from other people who are already super whizzes. Any questions burning in anybody? Let me unmute you all. Sorry, it's all very well me asking you there. Everybody's unmuted.
If I can pipe up, first of all, thanks for putting that together, because that's exactly what we need. And I'm slowly working my way through the one with from NatWest, and that summarizes everything they've asked for. So that's brilliant. The key question for me, and the reason I've held back actually on the loan front, is because of cash reserves. Could you give us a steer on what you think the best strategy is on cash reserves? Because I've heard a lot of people being rejected because of the loans because they've got money in the bank. So, you know, does it need to run out in 3 months, 6 months, 12 months? I mean, what seems to be the order of the day?
No, I think in your particular case, Stuart, and you know from a couple of your colleagues who are in a similar position where you have built up reserves, the whole point that you've built up those reserves is for a strategic reason, not just to feel good. And those strategic reasons still exist. So one of the reasons being that there's going to be lots of motivated sellers out there. So you want to maintain your position of strength. So you don't want to use your reserves to suddenly put yourself on a weak pile, and then you go cap in hand to the bank when you say, oh, look, there's an opportunity to us, and they say, well, no, we're not really got the appetite. So I think you just got to put a strategic plan together which says, look, these are the sort of things we were looking to do as part of our policy. So it's not just surplus cash reserves, that they were there for a purpose, and we need to make sure we keep that, because there's going to be even more opportunities now than there ever were before.
Okay, thank you.
Mark, from an accountant's point of view, have you got any thoughts?
Sorry,
So Mark Law.
Yeah. Can you run different scenarios on it?
Different scenarios. So you would have to do different versions of the model.
Right.
Yeah, that's how you would do it. Now you can really quickly copy and paste from one model to another, or you can do, another way of doing it would be, remember when I clicked generate funding proposal?
Yeah.
There are two things you can do. So you can go and you can put assumptions in, click generate funding proposal, change those assumptions, click generate funding proposal, save it as something else, then change assumptions, click generate funding. You can either do it, you can do it one of two ways. It depends whether you want to maintain all of the assumptions within the entire model within that scenario, or whether you just want to look at the output of that scenario. Does that make sense?
Yes, it does, yeah.
Yeah.
I think that's one of the areas that we've brought up, Mark, in terms of calling it sensitivity analysis. So for funding, the less complicated you make it, the better. But from a business point of view and planning what if, we do need to have that scenario planning. So that's one of the areas we're looking to try and build into the model, where instead of having to save different versions, we can have a what if section. But if you go to a bank with too many variables, they're simple people. They just want to know if does a thing stack up? Can you repay it? Is it justified? And then it's yes or no, because most bankers don't understand the balance sheet anyway.
Yeah, but I don't think you can only use it as a tool for going to the bank with.
No, that's what I'm saying.
Yeah,
your scenario planning is great for actually looking at the business from a strategic point of view going forward. Yes, definitely.
Yeah, and what you've got on the forecast report, which I only briefly touched on, is you've got that sensitivity. So you've got a sensitivity grid which shows you this is the profit that I've assumed. However, if my sales don't quite pan out or are better, and my margin is either worse or greater, this is the impact it has on profit. So you've got that sensitivity grid on your forecast report. And what we're looking at is bringing that grid into the funding proposal as well, because the numbers are all there. We just need to, the developers just need to ensure that that's reflected in the model.
Aniko, from a non-accountant's perspective, I see you sort of holding your head thinking, oh gosh, this is blowing.
Mind-blowing. It is mind-blowing for me. I was like trying to keep up with everything, but it is mind-blowing. It's fantastic, I think. It is fantastic because you have got an insight of where the business could be or what is going on, because it is a lot of things you have to take into account, and it is very fantastic, I think. So I was absolutely, very delighted, very much delighted to see something like this to come. And I was thinking, how could I kind of forecast my business? Because it's really difficult right now, not having the current and hopefully we're going to have it soon, the standard operating procedure. How are we going to set up the new practice? What sort of PPE we need and what sort of appointments and all that. So I was thinking probably in a month into working in that environment, I would be able to generate a much better kind of, future planning kind of thinking, because right now I can just think what it will be, but I can't say for sure. So I'm not sure whether I can keep all my staff, whether I have to reduce the wages, whether it's going to be different appointment systems, how many people, what sort of appointments, how, and that's very difficult right now.
Yes. No, I agree with you. And I think this would allow it. I mean, it might be, for example, shift systems that will be, so, where you are, you might find that where these impositions on your time are being put in, you say, well, okay, I can cope with that, just like people do with their offices. Some people are coming in the morning, some people are working afternoon, evening. And it might be that, for example, you two are trying to bring that in if the demand is just not being met, and you need to be able to provide it to work out a way. But you will have extra costs, and they will have to be reflected in your charges. I can't see any way around it. And it's last week we had a restaurateur, and you just think, well, I can't see if they're used to having 50 tables, which they're now going to reduce to 30. How they're going to make it go, because the whole thing has got to stack up. So that's why that what if planning definitely has to happen. I agree.
Yes.
But don't mind.
I'm not an accountant, but I have looked at the model on more than one occasion. I found it really, really useful. When you work it through, it is logical and it's sequential. And what you end up with is a really solid understanding. Well, solid. The accountants will probably laugh at that, but a solid understanding of the relationship between what's happening on the profit and loss account and the impact on the balance sheet and the impact on the cash flow. So, I mean, almost even if you didn't need the model for funding or for business planning purposes, although that second bit, can't see how that could ever apply, it's a very, very useful exercise just to understand exactly how the money go around works.
Totally, I agree. Yes, I agree.
And Aniko, don't worry about your mind being blown, because when I first heard Mark deliver that, I'm an accountant, and I said, wow.
Okay, thank you.
I'm going to have to look at that in my own time and listen to that again, because there's so much actually given to you It's so for a non-accountant, you think, God, where do I start? So
thank you for reassuring me.
okay, it's let me just quickly share my screen again. So we were talking about any questions which we've gone through. So the whole idea that we were talking about is, right, we're going to try and give you a detailed 5-year plan forecast and the descriptions that you can actually put as a proposal for lending. But, you know, even if you don't need it for funding, this is a system that can be shared with shareholders and your management team. So I think it's pretty detailed, which we're looking to make even more comprehensive in due course anyway. So that's something that we're going to develop. So I hope we've succeeded in that, even though your mind is blown. So say supporting funding requirements, and we're hoping also to add and give you an opportunity to benefit from cost savings and opportunity. Now, as part of the greater model that is behind all this that we're looking at, I was actually looking at a couple of bits of information recently on a couple of accounts we put through, and suddenly I got an alert on one of them, and it was an alert on the if the sales carry on as happened in the January quarter before the lockdown happened, we're going to have problems. And I thought, oh, that's really quite interesting, and that's because it goes down into a detailed analysis. But another alert was, look, there's cost saving opportunity. Your expenditure on telephone side is way over the top compared to what it should be based on our analysis of the transactions. So that's something that we're looking to be able to introduce and give you the opportunity to take advantage of in due course as well. And finally, there's also, apart from the cost saving, we're looking to try and give you an opportunity to go into a risk analysis tool. So that's something that we're exploring, but you know, this is apart from, there's one thing is just for the funding. So a risk analysis portal that will come in there. You can look at the business as a whole. First priority, survival. Next priority, growth. Priority after that is then look at what else you can do. So look at the opportunities there. So can I take this opportunity of thanking Mark for the presentation? That's extremely detailed. I really would welcome all your feedback to see what you like, what would you like to have done differently. And then if you, we'll take that on board and listen to it. We will send you hopefully tomorrow a follow-up where you'll get an opportunity to take this recording and also a copy of this model so that you can go and play around with it. And as Mark said, you can't make any damage to it because you can only enter the stuff where you're allowed to enter. So you can play with it to your heart's content. And if you need any help, you just know where to call. So that's the really important thing. So, you know, this is not us trying to sell our services, this is us trying to help and trying to be proactive. So if you think you know any colleagues who might like this, please do let them know, because again, this is not something we're trying to charge anybody for, but it's something that obviously will reflect well from us, from our point of view, the fact that we're offering it when other people aren't. So that so I'm not kidding myself that there's not another motive behind this. In helping you, we're also helping ourselves in terms of trying to be perceived as going the extra mile. You know, we're by no means perfect, but we try to improve as much as we can. So thank you for giving up your time, and look forward to your feedback. And thank you to Steve and Mark. We'll continue to help develop this, and if you give us any feedback, we will take that on board. So at that stage, let me stop recording if I can.